Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, still not good enough. ASIC cracks the whip, claiming big bank reviews into fees for no service practices have been, quote, unreasonably delayed. Your Money's chief business reporter Leo Shanahan has all the details there. Norway to segue out of its Australian and oil and gas investments. We'll discuss the impact of this on our resources sector with the Australian's Paul Garvey. The rise of ESG in the Australian corporate landscape. Well, my interview with Boston-based State Street Global's head of ESG, Rakhi Kumar. And politics meets business in the US. US Chamber of Commerce CEO April Palmerlee will join us to talk Trump trade and the rise of AOC, also the latest on ambassadors. Now, business is waking up to ESG, isn't it? The opportunity and the threat that environment, social and governance investment brings. And we're now all realising just how influential investment managers of all the billions of dollars in funds around the world have become. In the last month, Climate Action 100 Plus, a global collection of fundies including AMP, First State Super, Host Plus and Aussie Super, nudged mining giant Glencore to stop all new production of coal. Today, we hear the Norwegian Sovereign Wealth Fund, that's right, the wealth fund underpinned by Norwegian oil, will sell all shares it has in upstream exploration and production companies. We know the impact ESG has had on diversity, and as a result, the ASX 200 is light years ahead of, for example, the Australian Liberal Party. And last week, it was all about IR, how many unionists and some industry fund board members, and how they see it as quite appropriate that fund pressure should be used on company boards to push up wages. Well, we get to this morning and the front page of the AFR is claiming super funds are now a threat to the share market. Their sheer weight of money brings them huge influence, enough to demand seats on boards, enough to take listed companies off the board of the ASX altogether. Well, once again, we've been banging on about this ourselves ever since Aussie Super CEO Ian Silk shook things up last year when he jumped into bed with private equity firm BGH and made that bid for HealthScope, a company in which Aussie Super already had a sizable shareholding. Here's Aussie Super Chair Heather Ridout talking to me last week.
About 3% of Australian super's funds under management are currently in private equity, and that direct investment PE percentage is going to grow, and it'll grow till 10+% over the next period ahead as our funds under management grow. But we're also quite deliberate about this, and so we take our opportunities, whether it's direct investing ourselves, whether it's co-investing, whether it's joining with BGH like we did, but HealthScope was quite an experiment for Australian Super. We had an existing investment there. It was a good investment. We wanted to increase our investment. This opportunity arose. The investment committee went to huge lengths to avoid conflicts of interest.
But you tied yourself up exclusively. Are we going to see more of this?
Well, I think so. And those exclusive arrangements were done in the interest of the members of Australian Super. And the member first duty is right at the fore of this, and the governance that goes around that is right at the fore of it.
Really interesting, isn't it? Coming up, as I was saying, our interview with Rakhi Kumar, head of ESG investments and asset stewardship at global investor State Street. Right, first, let's just catch up with the regulator. ASIC is yet again slapping down the country's major banking and financial institutions, saying they've taken too long to conduct reviews into fees for no service failures. ASIC Commissioner Daniel Press saying these reviews have been unreasonably delayed. ASIC acknowledges that they are large-scale reviews. However, we believe the institutions have failed to sufficiently prioritise and resource their reviews. Financial Watchdog had instructed the institutions to start the reviews more than 3 years ago. Well, the delays are as a result of poor record keeping, failure by some institutions to propose reasonable customer-centric methodologies to identify and compensate customers, as well as a legalistic approach to determining the services they're required to provide. Back to unpack all of this, Your Money's chief business reporter Leo Shanahan joins me live at the desk. Well, we were going to see a more aggressive regulator, weren't we?
Yes, and look, I don't think there's any loss for ASIC in coming out and having another go at the Big Four as well as Macquarie and AMP over this, especially given such momentous failures in the Banking Royal Commission on this very issue.
But what are the criticisms?
Well, basically they're not devoting enough time and energy to this review. Now, I would find it amazing if they're not all devoting a lot of time and energy to these reviews as we speak. I think the problem has been that they didn't do enough in the first place, and now they're playing catch-up. As ASIC said today, they were warned about these reviews as far back as mid-2015 and early 2016 that they wanted them done. And of course, the problem itself was reported to ASIC back in 2013. We've seen some work on that. But the problem then came the Royal Commission, and it became such a central issue in the Royal Commission that by the time it became front and centre, it was too late because the banks were so devoted to the Royal Commission and playing catch-up there as well. So I think what's happening now is, the banks are being caught on the back foot. And look, it's interesting too because the ones that had such perennial problems, AMP, CBA, NAB not so much called out in this report today, but still displaying some serious problems. You know, the ASIC Commissioner says, we believe the institutions have failed to sufficiently prioritise and resource their reviews, particularly as ASIC has advised them to commence reviews in mid-2015, early 2016?
Yeah, well, I mean, I remember back to September last year and that breach report that ASIC did, and they were obviously absolutely furious about the time it took to identify the breach, to fix the breach, and then to remediate after that. And it all took years, way too long. So what's happened with remediation?
Well, now they've put aside, well, so far there's been $350 million paid out. As we found out, the bulk of that is some of the big banks. That CBA, I think, was the largest. NAB is obviously in a lot of trouble over this themselves. They're facing another ASIC court case over this very issue that is obstructing the regulator or not being 100% clear, some would say lying, about their role in this or their obligation in this. AMP, of course, well, it's almost brought AMP to their knees. Now, the banks themselves have then put aside another $800 million for this, which would bring that bill to over $1 billion. And I think the importance of these reviews, though, is that we have to make sure this money is paid out. This isn't just a bill for the banks. No. It's customers' money.
Yeah,
and that's
it's remediation. Point. And what about the poor performers? Who comes out of it?
As I said, it's interesting. CBA today was attacked over what ASIC called fundamental disagreement of their approach to evidence of three of their financial planning arms. Now, they are the somewhat ironically named Wisdom Financial Management Pathways, as well as Count. Now, they were
Count Financial.
Yeah, who were famous for charging dead people. And so they were in. So it is interesting that even now, in December 2016, CBA had to go back and say, OK, we will do another review, our own review. This is what looks like has taken place because Count, Pathways and Wisdom haven't done the review properly, according to ASIC. And CBA has come in and said, we will do another review. AMP looks like it could have a small problem on its report card, among many other problems, in that it can't properly identify previous licensees. Now, then you could get a situation where you have a second wave of former licensees. If you then identify these people who previously you hadn't identified, these financial planners, etc., who had left, and all of a sudden it turns out they were also charging fees for no service.
All right. Leo Shanahan, thank you very much. Thanks, nice to have you back. Well, more than $870 million worth of shares in Australia's major oil and gas companies may be dumped as the world's largest sovereign wealth fund in Norway moves to reduce its exposure to global energy explorers and producers. The fund says it wants to help the oil-dependent country avoid over-reliance on lower oil prices, while also citing climate risks as a, quote, important financial risk factor behind its decision. The fund holds stakes worth hundreds of millions of dollars in several Australian companies, including Woodside Petroleum, Beach Energy, Santos, Oil Search and Caltex Australia. Well, for more on this story, I'm joined by the Australians Resources reporter, Paul Garvey, who joins us live from our Perth studio. Paul, nice to see you there. Now, was this much of a surprise, and what is the real reason behind why the Sovereign Wealth Fund would move like this?
Yeah, look, it's not a massive surprise. There had been, I guess, signals out of Norway previously that they were looking to do something of this sort of nature. As for the reasons behind it, there's two main things being put forward. One is that this is purely a sensible investment decision. Norway is hugely exposed to the vagaries of oil and gas prices, and that therefore, as any good investor would, you're going to diversify the portfolio, and there's no need to have this sort of position in these oil and gas juniors. But the other hand is the climate change factor here, and you know, I think while the bank is saying it's about diversity with a little bit of climate change on the side, I think, you know, you see, if you're a CEO of an oil and gas company, you probably wouldn't be doing your job right if you weren't really acutely aware that there's a lot of investors out there who are increasingly mindful of the climate change impact of the companies they invest in. And it's crucial, I think, for these companies to be on the front foot to keep investors interested in the story and demonstrate their climate credentials.
Yeah, well, as Lex pointed out, I think in the FT that you know, it's all very well, but this sovereign wealth fund did grow fat on oil, didn't it? Yeah, and I think a lot of people are pointing out that sense of hypocrisy today. That, you know, this is a country, which has grown very wealthy on the back of its oil and gas industry, and for it to be suggesting that that it's wrong to be holding investments in oil and gas, you know, the hypocrisy is quite apparent in that respect. Indeed. So who's it going to hit in Australia? I mean, we've mentioned they've got shares in a lot of these big Aussie companies, but at the moment, what is it actually pulling back from? It's quite specific, isn't it?
Yeah, so there was the name of the actual individual stocks which came out of the week, and I think you might have mentioned a few of them. Really, it seems like it's almost across the board in the Australian listed oil and gas space.
Right.
I think the ones that will probably get hit the hardest, though, are those ones at the smaller end, where you know, I think the pool of natural investors for that that end of the market is a lot smaller, and where, you know, a big investor coming in, or in this case going out, can really impact on prices. And I think you've seen that on the market today, with a lot of oil and gas stocks down quite meaningfully on the market today.
Yeah. So this is a double whammy, though, for those in the West, because they've just had that extraordinary EPA decision, haven't they? What was that about? Yeah,
now this is really interesting, and it's quite fascinating. As I was saying, you know, companies needing to be aware of the climate change concerns of their investor base. And, you know, companies have been out there, you know, demonstrating their clean credentials, saying they're part of the solution, not the problem, that their gas is cleaner than other alternative sources, and that they're an important part of fixing the issues. Yet, when a regulator like the EPA comes along last week and says, well, actually, guys, we want you to fully offset all your carbon emissions from your future projects, the industry response was pretty strong and swift, saying that they think it's a terrible idea and a really poor piece of public policy. So under those proposed changes, yeah, as I said, the EPA is talking about requiring new projects to demonstrate how they fully offset all their carbon emissions. The industry is up in arms, saying it's a big impost on projects that can actually displace a lot of dirty coal production in neighbouring countries.
Well, I would have thought too, right. And just hang on a minute. When did the EPA, as some sort of regulator, decide that they would jump in on an issue like this? I mean, it's all very well for a bureaucrat at the EPA to suddenly decide on no notice at all that these will be the new rules. I mean, it hasn't happened anywhere else in Australia, and you would have thought that the state of Western Australia, who relies hugely on the gas sector, would actually be slightly crippled by this.
It would be, and I think the Premier Mark McGowan's made that quite clear that his number one priority is creating jobs. I think he's moved to distance himself quite quickly from this move by the regulator. A lot of people are sort of saying really should perhaps sort of stay in its lane, that it shouldn't be politicising things. The EPA for its part is just saying, well, hang on, we're the environmental regulator, we're here to protect the environment. And that climate change is a very real part of that.
They could get rid of all cows as well on that basis. I mean, it just seems extraordinary.
Yeah, it's a big move, and I think it's one which has brought an awful lot of heat on the EPA, a lot of pressure on board members there to justify taking such a big step, which can affect billions and billions and billions of dollars of projects, which have meaningful impact on the unemployment rate in Western Australia, an economy which is only just really recovering from the last downturn in mining and oil and gas. Putting that at risk now with a policy like that, and I think the reason why Woodside in particular have been so vocal in their opposition to this move is they're in the middle of a process trying to sell a big equity stake in one of their projects, and having a piece of policy come along like this out of left field, that takes zeros off the check they may get for selling that stake, unless this is resolved and buried. So that's why they've been so aggressive, I think, so far to try to knock that change on the head as quick as they can.
Yeah, Paul Garvey, thank you so much. Sovereign risk, eh? Wow. Thank you very much. After the break, diving deep into ESG with State Street's head of ESG, Rakhi Kumar, next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Now, the power of passive investment. In a way, it's anything but passive these days, particularly when it comes to the new wave of demands around environment, social issues and governance. Take the global house State Street Global Advisors, with now $2.8 trillion under management, including $29 billion invested in the Australian equities market. Rakhi Kumar is a Senior Managing Director and Head of ESG Investments and Asset Stewardship at State Street. She's out from Boston to talk to the investors she advises. Rakhi Kumar, welcome back to Australia. Now, State Street investors, passive investors, how do you drive change in the companies that you're investing in?
Yes, so we are a large global investor with $2.7 trillion of asset under management. And as the third largest investor in the world, we have the ability to, through our index portfolios, hold companies across the globe to principles that we espouse. And so regulatory arbitrage. So for example, I like to say that impacts of climate change don't stop at geographic borders, right? We engage with companies, whether they're US companies, Australian companies, European companies, around expectations and our commitments to TCFD.
Now, for example, we've been watching Climate Action 100 Plus nudge Glencore a little bit. Some would say it suits them strategically, but nevertheless, there's been movement. Now, do you support Climate Action 100 Plus, or do you do things another way?
So we actually, we support Climate Action 100 Plus from the outside. We're not part of that group. However, we engage with most of the companies that are on that list. But in addition, we're also changing the conversation, because the Climate Action 100 Plus is focused on three particular sectors: oil and gas, mining, and utilities. However, as an index investor, climate change is impacting all parts of my portfolio. And so we're just coming up with a paper on the impacts of climate change and the disclosure, quality of disclosure by agriculture and forestry companies on against the TCFD, using a TCFD lens. So, and then we intend to keep raising awareness of climate impacts that both influence climate, how climate influences different sectors, but also how different sectors have a role to play in reducing climate change.
So a big cattle company here in Australia, you'd be concerned about the amount of methane they produce?
That's exactly right, because and what we found, actually, if I could share some of the initial findings of that paper with you, what we found is that agriculture and forestry companies are very aware of the risk climate change plays on their business, but most of their processes are focused on their own emissions. So they're about setting goals for their own emissions, etc. But climate change also impacts the strategy and the adaptation narrative, and ag and forestry companies really have to do a better job in providing more insights to investors on how they're strategically positioned.
Yeah, so is that a transparency issue, or have they just got to stop? Because I know when AOC, Alexandria Ocasio-Cortez, brought this up as part of her new Green Deal in the United States, there were, people were absolutely horrified that, they'd have to just stop producing beef.
Right, I think it's about a sustainable world, right? And that's where we are right now, is that we are going to go through an economic transition. It's about adapting, it's about mitigating, and it's about building a sustainable future. So I think that the conversation about how things have to be done differently have to come up, but it's going to cause disruption, and we as responsible investors need to show the pathway of how do you go through that transition.
So what do you make of Norway's top sovereign wealth fund announcing that it's pulling out of new exploration in oil and gas?
So I think that really I can't really comment on what is their motivation based on what they have announced. It could be a exposure issue, because they are an oil and gas funded sovereign wealth fund.
Yeah, they made all their money that way, didn't they?
Yeah, so it could also, I really can't comment on their motivations. But
it might be a shift even at that level.
Right.
Yeah. So now you're here in Australia. ESG is very much about governance. What did you make of the Royal Commission into Financial Services?
Yeah, it's very interesting that. So I did, when I read that report, and I was focusing on the governance aspect of it, and they really hit upon culture as an issue, and that's something we took on at the early this year. So it was. We published a paper and we called on ASX 100 companies as well as S&P 500 and FTSE 350 companies to look at culture systematically at the board level. And the reason we did that is because every time we spoke to a company on culture, it was almost always after an event. Irrespective of what triggered the event, the fix was, let's change culture. Something was wrong in the culture. So as an index investor, and this goes to show you how we create value, is if we engage with companies systematically before an event and get boards to focus on culture, we probably will be helping create some value and fixing culture before it becomes a problem.
Rakhi, I was talking to David Gonski last week. Now, he's chair of one of our big four banks. He's done a lot in the corporate governance space. And I asked him what he thought had gone wrong. Top of his list, he put short-termism by boards. Now, what are you doing to try and stop short-termism?
And for us, short-termism is as much of a concern as a long-term investor. And the way we approach short-termism is we bring up issues that really destroy value in the long term. These are sustainability issues, ESG, environmental social governance issues, where the time horizon, if it's a probability impact issue and the time horizon issue, and the time horizon of something, the probability of something going wrong is very, very small. But when it does go wrong, the impact is significant. And so for us, by raising these issues and not focusing on a quarterly performance result, etc., that is how we keep the board focused on long term.
Rakhi, you're here pushing the idea of annual elections of directors to boards. Now, I understand the AICD is sucking on this. You could argue, though, just as you're getting your head around as a director over the first 12 months, getting your head around the board, you're then thrown up to the whims of investors and whatever issue they really care about. Does this really help long-term thinking?
So we haven't seen long-term thinking being impacted in other markets that actually do have annual election cycles. And I think what it has done is, yes, it's an anti-defensive mechanism, but investors still take action. They just take action on the wrong individuals, or they have different ways. So, for example, we at State Street have called on boards to have, that do not have a woman on their board, to have a woman. And typically outside where there's annual election cycles, we will take voting action against the chair of the nomination and governance.
And we have the 3 strikes rules, don't we?
Yes, but again, that's another good point you're making, because even if you have a 3 strikes rule, I haven't seen one instance in this market where investors have been short-term and have spilt the board. Because all our investors, and you've got to think of who your domestic investors are, they're super funds. They're the ones who actually are here for the long term. They have retiree money they're managing. So they know it's not in their interest to throw the baby out with the bathwater and just to make a point.
Rakhi, we know what ESG has done for diversity and indeed at the moment on climate change. What about the other great moral challenge of our time, which is wealth inequality? Now, in Australia, we've got pressure now on super funds, industry super funds in particular, from unions who would like the funds to use their leverage on companies to actually hike wages. Where do you sit on this?
Yeah, the wage, so for us it's all about human capital management, and this is the next frontier of ESG, which is the S. And it becomes very political very quickly because it's about people. It's about our populations. It's about our colleagues. And I think what we are trying to do is have this conversation with companies in a manner which talks about long-term value creation. So our conversations around board culture very quickly become touch upon human capital, because you really can't talk about corporate culture without talking about how you're managing your human capital.
But if investors are going to interfere at that level, and maybe they should, if they're going to interfere at that level, they're going to actually put pressure on boards to instruct management to hike wages, even though that might be spending shareholders' money in order to do it.
Yeah, so let me give you an example, actually. So the way we call it pay strategies. And when we talk about it with companies, we really want to understand how it fits into their business strategy. So I'll give you an example, right? So we had a company, which was a fast food company, that actually talked about, which had minimum wages. And they then went about and talked about how they were moving away from minimum wages. But it was mostly franchisee companies, that was only for self-owned stores, not franchisee companies. And so we raised it with them, saying, well, this is kind of a dangerous game, because most of the average individuals working in your franchisees are not going to see this. So how are you addressing it? And now the company has really thought about the strategy in the context of its business, and it's really positioning itself as a good first place to work. It's targeting its employees with right out of college or in college, and they're even providing scholarships, right? So they're starting to think of it from a strategic perspective, and that's how we approach it.
Yeah. So in the US at the moment, perhaps due to the reforms, you've got a remarkable situation where you've got wages growth and you've got very low unemployment. In Australia, you've got low unemployment but stubbornly low wages growth. Does it concern you? Because I know it does concern a number of people I've spoken to in Australia's boardrooms. Does it concern you that there is now pressure from some industry funds to push up wages?
Yes, so I can't talk about industry funds and their stewardship programs, but I can tell you that from our perspective, we would like to understand it from a strategy perspective. And the flip side of income inequality, a lot of companies are aware of. It's disruption. It's disruption and it's dissatisfaction. And I think it's consumer-facing companies that are first ones to embrace different pay strategies. And the reason is because it's very tied to your brand and brand value. So we always see everything as a business issue, and it really comes down to how companies think of it from their branding, strategy, and returns perspective.
Rakhi Kumar, so interesting to talk. Thank you so much.
Thank you so much.
Now, the Morrison government will be cracking down on aged care providers taking advantage of the elderly through excessive hidden costs by forcing agencies to publish their fees or face tough new penalties. Sounds familiar? The change comes after the Commonwealth, quote, home care packages scheme was exposed with a litany of problems, which provides older people with subsidies that can be used on everything from social outings to help with cooking to a person to assist with showering and dressing. This is amid the ongoing Royal Commission into aged care quality and safety. Well, we had the first round of hearings in Adelaide last month, the second round due to commence next week. For more on all of this, I'm pleased to welcome Peter Scutt, CEO and founder of Mable, who joins me live at the desk. Peter, welcome back.
Thank you very much.
Right, well, look, we picked you up, started covering you when you were doing Pitch at Palace, but just to remind everybody what your business is and how you're connected with this sector.
Yeah, so we're a whole new approach to ageing at home. We're connecting people that need care and support to live independently. Whether you're ageing, whether you have a disability, we connect them with independent care and support workers in their local community. So it's a really model that empowers people with real choice and control over the services they need from people they choose. They also get to negotiate prices with independent workers. So that delivers a lot of better outcome to both the pieces and needing care and support as well as those that are providing care and support.
Right, so can I ask you then, looking at the Royal Commission we've just had, because there's been such focus on the Financial Services Commission, meanwhile we've got this Royal Commission going on into aged care. So far it's been about residential aged care.
That's right.
But what have the revelations really been?
Yeah, look, I think the Royal Commission is really focusing on the consumer and the outcomes they're experiencing, and I think they're looking at quality of life and safeguarding, and there's no shortage of challenges there, particularly with the growth in the ageing population. As you mentioned, next week the Royal Commission hearings will focus on home care. I think that will,
which is very much your space,
which is the space we operate in, and I think you'll find, you know, as has been reported in the press, there's a lot of dissatisfaction from consumers around the outcomes from those home care packages, the hidden costs and charges that taxpayers are paying for, along with the lack of choice consumers are receiving, the confusing system.
Yes.
You know, I'm sure the Royal...
So these are sort of government programs we're talking about?
That's right. So the government has programs that fund people to live in residential aged care facilities as well as programs for people to remain living at home. Now, overwhelmingly the preference for people is to live at home, to live in their own home, be engaged in their community, maintain relationships. Home care packages are critical for people to be able to do that. But as we've seen, there's a shortage of home care packages, so there's about 127,000 people on a wait list.
So do you think one of the outcomes is going to be that actually there needs to be more money?
I think one of the outcomes for sure is the government's going to have to put more money into home care. In fact, Ian Yates, the CEO of CODA, was saying in the press recently it's going to be a minimum additional $5 billion at an absolute minimum.
Wow.
Plus you've got to remember that we have an ageing population, so demand for home care is only going to increase.
And you go on.
I was just going to say, you know, so one of the things that's clear to me is that consumers need more from their funding. The government needs consumers to get more from the funding. And the workers need more from that funding because we're going to need to pay workers more. The sort of old system has really undervalued the work they do.
But the rip-off has got to be exposed and stuff, because here we are, I mean, just looking at the Royal Commission's what they've exposed to date, I mean, the level of rip-off is quite extraordinary, some of this fee gouging that's going on. So
yeah, and I think it's going to be really clear in the hearings next week, because there's been a lot of reports out recently that the government's commissioned that are going to the Royal Commission. They've been picked up in the press. So in many cases, consumers are saying half their home care package is going in admin and case management. Half. They're then being charged sort of $48 to $50 an hour for services, and some of those consumers are reporting that the workers are getting $18 to $20 an hour. So there's fees on top of fees. In many cases, we think that potentially, you know, 70% of the funding goes in delivering 30% of the funding in services, and those things are really unsustainable. And I think part of the problem is consumers are just really largely in the dark. The government's introduced some great reforms around consumer-directed care. There's now individualised funding, a right for consumers to choose the services they want from whom and what they pay. The problem is consumers aren't aware of those reforms, and providers are really happy to leave them ignorant and therefore at the mercy of their better understanding of the system. So, you know, one of our big mantras is that if consumers are informed, they just have a little bit of information and a little bit of advice, they're getting dramatically better outcomes. And I'll give you an example of that. In recent reports to government, consumers are saying with a level 2 package they're getting 3 hours a week. They could be getting 6 or 7 hours a week with that same funding. For a level 4 package, which is $50,000 per annum of funding, they're getting 14 hours as reported, but they could be getting 22 or 24 hours a week. And that additional hours is critical for quality of life. Of course. For people's ability to stay living at home.
Yeah, yeah.
And I should say that, you know, taxpayers are funding that. So.
Right, right. Well, Peter Scutt, I'm sure this will come through in the budget, come through in the Royal Commission, so we'll keep in touch. Thank you very much.
Thank you very much for your time.
After the break, talking trade, Trump and AOC with the American Chamber of Commerce CEO April Palmerlee. Next.
This is Ticky on Your Money, covering the big business stories.
Yes, welcome back. China and the US continue to work day and night to ink a trade deal, we hear. China's Vice Commerce Minister saying while he was optimistic about the ongoing negotiations with Washington, any agreement must be equal and fair. Speaking in a rare news conference on the sidelines of the annual meeting of Parliament, highlighted slapping duties back and forth was bad for workers, farmers, exporters and manufacturers. The governments of the world's 2 largest economies have been locked in a tariff battle, haven't they, for months, as Washington presses Beijing to address long-standing concerns over Chinese practices and policies around technology transfers. Progress on the talks saw the White House indefinitely delay hikes in tariffs on $200 billion worth of Chinese imports, set to take effect in March, on the 2nd of March, but with no meeting scheduled for senior negotiators, questions still remain on if one will be done at all. Well, for more on trade and the US political climate broadly, I'm pleased to welcome April Palmerlee, CEO of the American Chamber of Commerce here in Australia. April, great to have you here. I'd love to talk politics as well, but can we just knock off trade? You sit there running the Chamber of Commerce down here. What are your members saying to you about this trade war?
I think that there are opportunities as well as risks for companies operating in the Asia-Pacific region, and we have to look at both sides of it. It's not a full-blown trade war yet, and I hope that we will be able to avoid one.
Well, Donald Trump pulled it back, didn't he?
He did, exactly. And some people feel that since he walked out of negotiations with North Korea, he's actually in a stronger position to drive a trade deal through with China when it comes to that.
All right. Going to the election, though, he's got so many balls in the air. He's got his jolly old wall he's trying to put up. What's been the response to this issue of a possible veto around the emergency bill that he's put through?
Well, it looks like the veto would stand. They wouldn't have the votes to overturn it. So it looks like he will try and push the funding through. He's trying to get $8.6 billion into the 2020 budget that he proposes. And there is strong sentiment that he's doing the right thing. He has
even though that takes money from other worthy areas.
Well, he said that he would take some of it from forfeitures at Treasury Department, drug interdiction from the Defense Department, military construction projects. So it's coming from a few different places. But Americans do agree to some extent with him when he says if you don't have a border, you don't have a country. And he's seeing over 90% approval ratings within his own party.
So, April, you're looking at America now. We've had those tax cuts that came through right from the get-go. We're now in a situation, as I was mentioning earlier, where you've got this incredible low unemployment, but wages growth, and not insignificant wages growth.
A 10-year high in wages growth. That's right. So we're seeing the culmination of the deregulation, the tax cuts, the economic expansion that's finally reaching the American workers, and that's going to have a very buoying effect for President Trump.
Do you think that's a message for Australia here? We should try it?
Most companies that are in the American Chamber of Commerce would support tax cuts, absolutely.
Yeah, yeah. All right. We've got an election, of course, in 2020, presidential election. How do you think Donald Trump will go?
Well, right now there is no centrist candidate for the Democrats. We see Mike Bloomberg, who would have been a centrist candidate, saying he's not going to run. Hillary Clinton has ruled out running. The CEO of Starbucks is getting pushback from his shareholders about whether he could run a big company and run for president.
Yeah.
So we have Bernie Sanders out there running on a socialist platform.
But also this new woman, AOC, Alexandria Ocasio-Cortez. What do you make of her?
Well, she's a phenomenon, much like President Trump is. She has 3 million Twitter followers.
Yeah.
That's more than all of the congressional leadership combined.
And she's young, she's gorgeous looking, and she's doing a Trump from the left, I hear, Neil Ferguson says.
She is, exactly. But she's only 29 years old. She's a first-term congresswoman. She's not even old enough to run for president. The Constitution says you have to be 35 to run for president. So it's a while before we would see an AOC candidacy. But she certainly is pulling the interest of young people to the left and creating this movement for a new Green Deal.
Could she bring the candidate that the Democrats end up with? Could she be pulling whoever the candidate that is, either to the left or even if it's, you know, a Biden or someone like that, having to put in left policies to appease that side?
I think between her and Bernie Sanders, absolutely, we're going to see the electorate getting pulled to the left. But Trump counters that by saying Venezuela. That's what you think when you think socialism. So her new Green Deal, her Medicare for all, she has a lot of ideas, but they're not always grounded in facts.
Yes, yes, and business presumably would be rather worried about this, I think.
I think a lot of her policies would have to be examined very closely if she were to toss her hat in the ring for a national position.
Yeah, yeah. April, you must be thrilled. I know you had a great acting ambassador, but you've now got AB. Tell us about AB here in Sydney.
Yes, absolutely. Our chargé d'affaires, who has been acting as the ambassador for almost 3 years, has been absolutely fantastic. Jim Caruso is lauded by the business community and Americans living in Australia very, very highly, so we certainly haven't suffered. But President Trump's nominee, A.B. Culverhouse Jr., is in Australia, and we expect to be seeing him on the scene very soon. It'll be a great thing for American-Australian relations, just like Australia's been served so well by Joe Hockey in Washington all these years. I think that America will be very well served in Australia with our new ambassador. He has a very fine pedigree within the political system in America. Obviously, the president values his counsel highly, and he has a lot of good connections.
Well, so important because one of the top candidates, if we remember right, got diverted, was going to come to Australia, but got diverted. And it was a big question over how committed Donald Trump was to Australia and to the region. Does this send a sort of message of confidence, do we think?
I think it's a sign of how strong the Australia-America relationship is, that Admiral Harry Harris was initially nominated, a real heavyweight for the region, but then it was deemed that he was more needed in Korea, and so he was sent to Seoul. But having someone of the stature of A.B. Culverhouse sent out here really does highlight the importance that the president places on the U.S.-Australia relationship.
Now, you mentioned Joe Hockey there, obviously, our ambassador in Washington. We've also got the possibility of a change of government here, which could throw anything up. Now, Bill Shorten is on the record at saying after Joe Hockey's sort of being caught up in the Hello World scandal, there'd be much more of an inquiry. Do you think he's going to stick around, Joe Hockey?
He's been there 2.5 years, and I think he's done a tremendous job. I think he's exactly the right person for the right job at the right time.
He seems to have some sort of relationship with Donald Trump, which
he does. He's gone golfing with him. He has the president's ear. The president knows him by name. It's a very good relationship. The president says yes to Australia more than he says yes to most other countries. We have an exemption on the steel tariffs. Our free trade agreement is intact.
Well, BlueScope's pretty happy about that, remember? Yeah.
And so I think Ambassador Hockey's done a tremendous job. If there is a change in government, obviously there could be a change in ambassador.
Well, I asked Julie Bishop last week what she would feel about would she rule out a Labor appointment and possibly Washington? And, you know, I don't think she ruled it out.
I think we've heard the leader of the opposition say that he hoped that Julie Bishop would stay in public life and continue to serve the country. So I think that would be a very interesting appointment. She was a tremendous foreign minister. I think she still has a lot to give to the country and the public.
Yeah. So what are you busy with, April, at the moment?
I just came back from Hong Kong, where we had a meeting of all the AmChams in the Asia-Pacific region, and the talk was China, 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 of course. There was a lot of talk about the greater Delta region, the Hong Kongization of the Pearl River Delta in southern China, and how they're going to try and expand some of the economic prosperity that Hong Kong has seen to include more of the rest of China.
Any talk about Huawei?
There was a lot of talk about Huawei. The vice president of Huawei, who was supposed to appear at our conference, did cancel, so we didn't hear directly from them. But we did have a good meeting with the Australian Consul General there and with my counterparts from the region. And opinions vary on whether or not it's a threat.
Look, and it's a fascinating play. I mean, quite clearly, it's a trade play, an elephant bumping, as well as a genuine national security issue. Would you not think?
I think there are a lot of factors like that in play, absolutely, and opinions vary widely depending where you sit.
April Palmerlee, so interesting. Could talk to you for hours, but thank you so much for coming in.
Thanks, Ticky.
OK, now, after the break, more bad news for flood-affected AACo. We'll get across the details with Forager Fund's CIO, Steve Johnson.
Now, back to Ticky.
Yes, welcome back. The Coalition has suffered its 50th consecutive news poll loss and its worst result of the year, actually, in the wake of further cabinet retirements. The latest news poll conducted for The Australian shows the Coalition trailing Labor 46-54 in the two-party preferred vote after falling 1 point. It would result in the loss of 18 seats for the Coalition if distributed on a uniform basis across all electorates. The Coalition has also dropped a point in the primary vote to 36%, while Labor has kept its primary vote at 39%. But Scott Morrison has maintained his lead over Bill Shorten as preferred Prime Minister, despite the gap narrowing 2 points. Mr Morrison has fallen to 43%. The Labor leader has risen to 36%. A recent bout of merger mania in the gold space could see Newcrest emerge as the biggest winner amid a takeover tussle between Barrick Gold and Newmont Mining. In an interview with the Wall Street Journal, Newcrest CEO Sandeep Biswas suggested the company's acquisition of a Canadian gold pit may be just the beginning. We don't feel restricted in any way, he says. This is a measured entry into North America. It's not betting the farm on any particular transaction. But who knows what comes out of the Barrick and Newmont thing. We are sitting there, like everyone else, wondering what may or may not occur, he said. Newcrest will pay over $1 billion for a controlling stake in the Red Chris copper-gold mine as it secures a long sought-after footprint in North America. It comes amid a flurry of heavyweight M&A activity in the gold sector. According to Mr Biswas, the company's balance sheet can support more deals if the opportunity arises. Analysts have speculated that Newcrest is looking to buy Newmont's Noddington and Tanami gold mines. And preliminary estimates of the impact on the recent Queensland floods have had on Australian agricultural company AACo coming in between $6 and $8 million. The company flagging the full impact of the floods cannot be known until a cattle muster occurs, which will provide them with figures for livestock losses. As previously flagged, the Australian agricultural company has also suffered a financial hit due to the ongoing drought conditions, with estimated additional operating expenses of $28.5 million for the first half of the year, likely to be replicated in the second half. The company will issue a further update prior to its full-year results in May. Appen shares in a trading halt as it reaches an agreement to purchase software platform Figure 8, who specialise in machine learning using customised AI training data. Appen will pay an initial sum of $175 million US, with an additional fee of up to $125 million US based on performance and revenue targets. Purchase will be funded through a capital raising at an offer price of $21.50 a share.
So we've long talked to the market about the need for us to have technology to improve the rate at which we can deliver data, the quality of that data, the speed of that data, and of course the cost of that data. The acquisition of Figure 8 future-proofs our business. It achieves everything we need from a technology standpoint. It accelerates and de-risks our technology strategy. It gives us recurring revenue. It gives us more customers, and it gives us, a fantastic team of staff, all based in San Francisco, with some engineers, some data scientists, and sales and marketing people that really add to the business.
Well, for more on the latest of a couple of companies, Steve Johnson from Forager Funds joins me live at the desk. Steve, nice to see you. Look, AACO, poor people, actually. I mean, they've had drought and then they've had flooding rain. Hugh Killen giving an update today.
It's tough business, isn't it, Ticky? It's straight out of a Dorothy McKellar poem.
Yes.
And all in the same announcement. You've got drought hurting one part of the business and floods hurting the other, and the business wasn't going great.
Well, that
prior to all of this,
1% of Australia they own, literally, land. Yeah. 1% right across it.
And that's actually their saving grace. I mean, this business has not been generating cash flow for a long time. If you add up the past 10 years, it's cash out the door. But they've been able to do that because the price of land has been going up. There's a lot of foreign interest in land, and the banks are very willing to lend against that. So it's a business that has a huge amount of asset backing. There's more than $500 million worth of land in this business and on the books. But
I seem to remember you weren't 100% convinced about Hugh Killen's strategy. Now, he, of course, had a huge amount of experience on the finance side. He came in with this strategy. He's put, I think, a very good COO in there, and he's got this strategy of high-value marketing, exporting. But do you think that will work, given this sort of crush now? I mean, wouldn't it be a saving grace in a way?
I think it's the right strategy, and I think our whole agricultural sector in Australia can do a better job of brand Australia and selling that to the rest of the world. So I think it is the right strategy. It's still, at the moment, it just pales in significance relative to the size of, like you already said, they own a huge amount of land. It's a very asset-intensive business. They own a lot of their own cattle, and I think to do that branding really, really well requires a special skill set, and you don't necessarily need to own all of those assets, right? You could, like A2 Milk, for example, you could create the brand without having all of the assets that come with it. And look, there's been a number of very significant strategic blunders here. They set up an abattoir up in the Northern Territory. It cost $50 million from recollection, and they've had to shut that down because it wasn't making any money. So I think
it's on ice.
I think the strategy has been, you know, this is I think it's the step in the right direction, but it's all about execution, and we haven't seen a lot on the execution front yet that's impressed me.
OK, now Appen is in a trading halt. I'm finding it very difficult to understand this company. They're going to have an equity raising, are they? Or
they're doing an acquisition, yes, and there's an equity raising to fund that acquisition.
Yes.
It is a very significant acquisition in terms of size.
Yes.
The Appen share price has gone absolutely nuts, so they have a market capitalisation now that is big enough to do big acquisitions, but they're buying a loss-making business that has also been growing very quickly, but a loss-making business that they say is going to help them very strategically. It worries me a little bit. We've seen with WiseTech over the last 3 or 4 months some of those acquisitions start to unravel. You have the hubris that comes with a high share price. You turn around and say, well, we can do anything now, but the business has been outrageously successful, and you know, it's...
You like it?
It's expensive, so I don't love the stock price, but I think the business has been and exceeded all of my expectations. I mean, a simple way to explain it, they've got more than 1 million people out there providing them with data that they then give to companies. There's all of this talk about artificial intelligence, but that artificial intelligence is only as good as the data that you feed in, and this business has been able to play off that trend by providing the right sort of data that people want to test all of their different algorithms and things on. So it's been an outrageous and another Aussie tech success story. So I think it's something that we should be happy about.
Hear to that. Steve Johnson, great to have you in. Thanks very much.
Thanks, Steve.
Well, that's all for the show tonight. Tomorrow night, Chief Advocate for National Seniors Australia, Ian Henschke. Thanks for your company.